everybody. Welcome. Good afternoon, good evening, good morning, depending on where you're at. Glad you're here today. As you know, we've been doing this Smart Money Moves panel once a month, and the turnouts have been great. And I like to see people coming back, seeing the different speakers and seeing what they can learn. I titled this series, Smart Money Moves, because really, what's the smart money doing today? What are they doing in the market? So let me just say, whether you're joining us today as a passive investor looking for a place to put your capital or to be more intentional about where you're putting your capital, we're looking to build more meaningful relationships with you, so you're in the right room. Good news, we're not going to be selling you anything today. So if you came here thinking we were pitching a deal or selling a program, that's not happening. So if you're in the wrong room for that, maybe you can learn something. I know we won't disappoint you though, but we're here to bring you some education to help you make better decisions on your investments in the coming months. With the market shifting quickly again, now how do you position your investments better for the coming months? We're living in a time where traditional paths to building wealth like stocks, savings accounts, bonds, even single-family real estate are being challenged more and more. Investors are turning towards alternative investments and specifically multifamily real estate, for one simple reason. They're looking for cash flow and they're looking for tax advantages along with building long-term wealth and creating that long-term wealth for their family, without having to deal with tenants, trash, and toilets. And, that's the one thing that we always talk about is by investing as a passive investor in a syndication, you're not dealing with those tenants, trash, and toilets. So that's what today's about. Today, we're going to go beyond surface level conversation. We're going to dive into what it really takes to build trust with investors, to communicate effectively before, during, and after the deal, to scale your capital, to scale your investments, and to develop the mindset required to operate at a higher level in this space. And to do that, I brought together 3 experts today who are actively doing this at a high level. We have Michelle Fitzpatrick on with us today, Matthew Tufke, and Vessi Kapulian. And I'm going to let them introduce themselves in a minute here as we get going. But each of them brings a unique perspective, from building investor relations and raising millions in capital to structuring deals, nurturing relationships, and scaling their platform. These aren't just theorists. They're in the trenches doing deals, working with investors, and navigating the same market conditions that we're all facing today. So my encouragement to you is to lean in, take some notes. Hey, if you're driving, maybe pull over and pull your journal out. And more importantly, think about how you can apply what you hear today so you can begin to deploy capital again and come off the sidelines. Because at the end of the day, the business comes down to one thing: people, relationships, and trust. And if you master those, you can win in any market. Today, all we need to do is answer one question. Do you trust any of us to be good stewards of your investment capital? Why don't we dive in? Michelle, why don't you tell us who you are and a little bit on your background and what you do?
Sure. Thanks. I'm so glad to be here. Thank you for inviting me. I feel like we've probably been doing some of these podcasts and webinars. I've been joining you for the last few years, maybe longer. I'm not entirely sure, but I always walk away with something that I didn't know or something that I learned. So even though I've been in real estate for 25, 30 years, and even though I've been in the 1031 space for 12 years now, I come away from these summits learning something every time. So I do appreciate that you continue to do these. But my name is Michelle Fitzpatrick. I'm with Northern 1031 Exchange. We act as the qualified intermediary. Anytime you are doing a like-kind exchange, you do need a qualified intermediary, and that's the service that we provide. And I think, Mike, you stole my thunder a little bit, because our tagline is doing a 1031 exchange allows you to preserve all your profits and build your wealth faster. So that's kind of what we tell people. If you do a 1031 exchange, you are going to preserve all of your profits. You do not have to pay the IRS, your state taxes, that anywhere from 20 to 35% in taxes. In states like Massachusetts and in California, you may be looking at 35 to 40% in any sort of capital gains tax. So 1031 exchange allows you to redeploy your capital and really build your wealth, build your long-term wealth quicker. So that's what we do, and that's where we help our clients.
Awesome. Thanks for being here, Michelle. It's hard to believe, you're only 29 and been in the business 25 years.
Can you believe that? It is pretty amazing. I know.
Hey, Vessi, welcome.
Thank you, Mike, and thank you for hosting all of us today and creating a great environment for investors to learn and really get equipped with the tools so they can be savvy and more empowered. But very briefly about myself, I work with founder-led enterprises, family offices, and sophisticated investors and help them make better strategic decisions around governance, risk, and capital allocations. Specifically, when it comes to real estate investments, I help them make more informed decisions or through rigorous underwriting, sponsor diligence, downside risk analysis. And so in addition to second set of ideal reviews and investor education, I very selectively co-invest in apartment opportunities if the timing, the sponsor, the market, and the deal all align. And so my background is very much shaped and my lens is very much shaped by my commercial lending and board advisory background, where protecting the capital and studying the downside come first.
Awesome. Thanks for being here, Vessi. I appreciate you. Matt.
Hey, everybody. Glad to be here. Same. It's always a blessing to connect and meet new people. I'm Matthew Teifke here in Austin, Texas, and real estate guy. I'm 35 years old, married, 2 kids, and been doing this since I was 18. I'm a big believer in being an entrepreneur. There's a real estate guy named Tremel Crow that I've studied forever and love what he did, but big on partnering and collaborating and pretty heavy in the multifamily space. Last year, bought around 800 doors and just put a 300 unit in Austin under contract. And my main goal is how can I bring value, connect with people. And I really enjoy, speaking, but also taking notes, right? Like there's so much that we can all share and pass on to each other. And big believer, like we all have certain skill sets, and how do we pull those skill sets out to benefit the team? So I'm happy to be here, excited, and thank you for the space.
Yeah, thanks, Matthew. I appreciate you being here. And you're so correct, right? Because I think I don't care how long you've been in the market or been in the business. There's always something new that you can learn, and I love younger people like you in the business because I learn from you, right? Because I don't know everything, and I certainly always don't know the right way to do things. So for those of you that don't know me, I'm Mike Morawski. I've been in the real estate space for about 30 years. I've written a couple of different books. I have a Amazon bestseller called Multifamily Investment Secrets. I'm a public speaker and author, real estate coach, and I also syndicate multifamily, owned and operated over 4,000 units. I had a property management company managing over 7,500 doors. So been in the business, seen some market cycles, seen the ups and downs, and learned how to make money when it's up and when it's down, and no matter who's in office or if there's a war going on or not. So, and we're not going to get into politics today at all. So we're excited about that. Hey, so listen, when it comes to smart money today, where's the capital going? And how do you think you attract capital in this market? Because we all know it's a tough cycle. We're in that part of the market cycle where investors are like, I don't know, the war is going on. I don't know if I should do this. Should I jump in? Should I not jump in? Their curiosity is there, but their commitment's not there. And why do you think that is? Vessi, why don't we start with you?
Yeah, absolutely. So I work with a lot of private investors, family offices, and there are a few reasons, even larger funds, to kind of echo your comment, Mike, with respect to capital raising. Even some of the larger, more institutional level investors are struggling, meaning it's taking longer to raise capital. I think that's a lot of that's a natural function of where we are at in the cycle. But also specifically when it comes to private investments, right? These are typically illiquid or semi-liquid vehicles. And so based on everything that's transpired at the global micro and macro level, a lot of these deals, whether that's apartments, speaking within the commercial real estate space, or even private equity, a lot of the tenors of these deals have had to be extended. And so that's keeping a lot of capital on the sidelines. I'll just mention the elephant in the room, right? It's no secret that multifamily and commercial real estate are going through their winter season as well. And so there's been a fair amount of distress, pause distributions, capital calls, and for a lot of investors, unfortunately, it's not just one, sometimes it's a series of capital calls. So if anything, a lot of them are not appropriately, right? Taking a step back and reassessing, doing deeper diligence on where to deploy that next dollar. I think the appetite is there. There's a lot of dry powder, but a lot of the investments happening today are down on a very, very selective basis, at least based on what I see within my world.
Yeah, thanks, Vessi. How about you, Michelle? What are you seeing from your perspective?
Yeah, so I mean, I agree. People are a little bit more apprehensive about locking their capital up completely and making sure when it's not liquid. So that's been something that I've been seeing. But our exchanges continue to happen. People are continuing to look for properties in syndications as well, just because there's not a lot on the market right now for people to solely, to wholly own. So getting into more passive investments that are readily available is something that we're starting to see a little bit more and more just in 2026.
Yeah. So you're saying there's an uptick in the exchange market where they're actually, because I know that, in the past, most exchanges, they buy their own property, but you're saying there's an uptick in the syndication space.
There are, I think, just in the last few years, and I know we were having this conversation a little bit offline before we started this webinar, and we were talking a little bit about the interest rates. And, people that have been locked into these really low interest rates for a long time have been apprehensive to exchange and get into another property in the last few years. I think now that the Fed has come down, 3 or 4 times last year, interest rates have really started to level off. I think people realized that it was an anomaly that, they were locked into 2, 3, 4% interest rates and during that COVID period, that they're okay with, starting to redeploy their capital, selling a property, buying something else. But there are those other people, especially the older crowd, people that are in the back nine of their career, their lives. They've been investors. They've been landlords for a really long time. What we're seeing a lot of is that they do not want to have those tenants, the trash in the toilets. And believe it or not, their kids don't either. We have a lot of older investors that their kids do not want to inherit their properties. So we're seeing some of that too.
Yeah, that's interesting. How about you, Matt?
Yeah, I think right now, in my opinion, every market's different, but it's easy to say, but I fully believe it, is now's the time to find deals, right? The last few deals that I bought, we were taking over the debt amount. And what I've seen is the type of investor is an entrepreneurial type person. Whereas, 4 or 5 years ago, it might have been somebody with a good job and good income, and they're just looking for stability and they're invested in multifamily. But now it's like the business owners and the people that understand you got to kind of be counter cultural or go against the grain to find opportunities. And, it's one of my pet peeves that people are like, you find the deal, you find the money. And it's kind of true, but not really, right? Like you've got to know people for a long time. They got to know, like, and trust you. And if you have all that and you have a track record, then maybe you find the money. But that's a 10-year journey, right? Or more. And so what I'm going after is the business owners and people that wait for this type of market because you never know, are we at the bottom? Could it go lower? You never really know. You can't time it. But what you can do is look at the fundamentals and like Austin, Texas, I'll give you an example. That's the market that I like. There's like this big national news about, what's going on with Austin, like everything's down, all this stuff. And it's like that's partially true, but when you look into the facts, right, of like there was oversupply, it was a crazy hot market, rates were different. Now you can tell a story. And so the capital is chasing the story from what I've seen. And I'm not like a $50 million capital raiser. I've raised like 12 million. But that there is capital that wants that story. And everybody's different, whether it's family office or individual investors. But there are people that are looking and waiting for this market environment to like find the steals when you're talking about these deals.
Yeah. I love that you talk about Trammell Crow, right? And he's actually one of my heroes too. But I was a Keller Williams real estate agent for a number of years, and I know you own a brokerage in Austin. And Gary Keller modeled Keller Williams after the Trammell Crow model. And what's always been interesting, and Keller always talked about this, is that uh, Trammell Crow always made money, no matter if the market was up or the market was down. And, there was always that space, and you said it, you said you can't time the market, and you really can't. But there's a good deal in every market. You just have to know how to look for it and where to look for it. And I kind of want to shift a little bit onto, market conditions, right? Where where do you see us? And Matt, I'm going to start with you on this. Where do you see us in market conditions right now in the cycle? Because I always say, hey, real estate, there's no geniuses in the business. There's only market cycles. And they go up and they go down. It's just how long do they go up and do they go down, and where are we at? But
Yeah.
go ahead.
Well, so to that point, right? You always hear real estate's location, location, location. It's the same as timing. And like you said, you can't time it, but you can see which way in the direction that things are going or they're about to go if you are a little bit patient with it, right? Like I wasn't, and I have no judgment, but I wasn't buying these big deals 4 years ago. And this is specifically in Austin. Like people were buying 3 caps and 4 caps.
Yeah.
So that's why the location and the timing both come into play in a big way, because the environment for, let's just say, multifamily in the Midwest is so different than it is in the South, right? Or wherever that may be. And so it's also very market based. And what I can tell you, this is my perspective, is Austin, Texas. This is the market that I know that I'm hyper focused on. There were just so many people that they paid 2 caps and 3 caps. And so 5 years later, when rates were going up double or 50% higher, they had to sell and they overpaid. And at the same time, because it was so hot, there was like a massive amount of construction. That storm, I like how I think Michelle said, like the winter season, because it's a season. And you can look at the development pipeline and say how many units are coming online versus what's the demand. And you can see specifically in my market that we're going to see rent increases in 27 because there's not enough units coming online, right? Austin had the lowest rents and still does in the country, which is crazy because on the other side, there's apartments that will sell downtown Austin for $700,000 a door for like a 400 unit apartment complex. So what that says to me is the big money knows what Austin looks like in 10 years, but there's short-term challenges. And so my opinion is we're coming out of that in Austin specifically. And then, like I said, like everybody's market's going to be a little different, right? There's the overall economy, but then very specific on what market are you in?
Yeah, and I like what you said about short-term challenges, but I also think that the investor has short-term thinking. They're thinking about today. They're not thinking about 10 years where, when you look at the bigger money, Warren Buffett's and the Blackstones and the hedge funds, they're looking 5, 10 years down the road, and where's a specific market going to be? Where's it headed? And that's what makes a difference too. How about you, Vessi? What are you seeing in the market?
Yeah, I mean, it's very market specific, right? I want to echo that in even within the same market, each sub-market may be very different. And so in some of the larger markets, we still see a sufficient amount, right, of supply overhang that will get worked through once demand catches up. Where I've seen more of the opportunities, interestingly, now has been in the tertiary markets. Now, I'm not suggesting go to any tertiary market. You still have to study the market fundamentals and supply and demand dynamics, jobs, all of that, and of course the individual investment itself. But it seems like the opportunities, or at least a lot of the uncovered opportunities, are in those less popular locations, especially. And for me, it's especially important to have that local boots on the ground knowledge, right? So Matt knows the Austin market inside and out. He's the go-to expert, right, in that market. And so for me, it's super important to have that local expertise. And when you go into those tertiary markets, that's even more so important and critical and relevant, because you are relying not only on the public data, which in many cases is limited, but also on the local know-how that may or may not be necessarily out there in the public domain.
Yeah. I like what you said about the tertiary markets. I read a report just recently from Yardi that Yardi put out about the tertiary markets. And I own a bunch of assets in Tulsa. And Tulsa was number 7 in the top 25 tertiary markets in the country for rent growth year over year. So from March of 25 to March of 26, the Tulsa market grew 1.5% in rent growth in that market. So, yes, I think the tertiary market is overlooked today, and that it's going to be a performer for sure. So, Michelle?
Yeah, I mean, I'm gonna just kind of mimic what both Matt and Vessi said. We're in the Boston market. People are starting to get a little priced out of the Boston market, believe it or not. There's not a whole lot of supply for the demand that I think that's out there for the multifamilies. I mean, we have people that are going into those tertiary markets. We have somebody right now that's actually selling a portfolio of properties out in Western Mass, which is, an hour and a half outside of Boston, and going out into buying multi-properties in the Ohio market outside of Cleveland. And he can get a whole lot more bang for his buck there. He's going to be selling, I think, 30 doors and buying like 100. So yeah, he's really excited, looking forward to that. So that's kind of some of the stuff that we're seeing just on a smaller level.
Mike, can I throw one quick thing in real quick?
Yeah, go ahead, Matt.
I think it's good to note when we're talking about like knowing a market. I've talked to brokers and they literally they're like, we're looking for the dumb money. Like, and they just say that, and so the reason I say that is for people to be careful. Like, you got to be locked in. You got to know what you're doing.
Yeah.
These brokers want to oversell a deal to people. They don't care. They're not going to own it, after they close. Like, they're not going to be paying the mortgage. And so that's why this knowledge and understanding markets and things we're talking about here is so important.
Yeah. Yeah. I have a good friend. He's been in the business a number of years, as long as I've been in the business, and they own and operate about 18,000 units right now. And they'll look at a deal, and his saying is always, hey, there's a bigger sucker, and that's that dumb money that you're talking about for sure. I wanted to ask, what are LP investors most concerned about right now? But, kind of a caveat to that, and how are they addressing those concerns? So, you're concerned about an issue or a challenge, but what are you doing about it? And Michelle, are you, what kind of feedback are you getting from the 1031 investor on, what they're concerned about?
When they're going into properties, I think people are looking for obviously cash flow and liquidity. But when the property is tied up and they have lack of liquidity, I think that's one of their issues that we see on a regular basis. People are a little bit skeptical about relinquishing their control and relinquishing the liquidity. I mean, those are really the biggest obstacles to overcome whenever we're doing an exchange, and then getting them into the property that works for them in that phase in their life.
Yeah. How about you, Vesey?
Yeah, I mean, sadly, it's through growing pains, right, that they're learning. But I actually appreciate that now investors are asking deeper and better questions, having learned from some of the experiences over the past couple of years. So they're doing deeper dives in the legal documents, PPMs, and operating agreements, or at a minimum, they're asking for assistance with that because they know it's important. So if maybe they don't have sufficient knowledge or experience to evaluate that by themselves, they're bringing in that second set of eyes support. Definitely deeper diligence on the sponsor beyond just the what we see in the typical offering memo. They're peeling the onion 2-3 layers deeper and really diving in to truly understand how reasonable the underlying assumptions are. Because if there's one thing they learned with the deals that closed right at the peak of the market in 21, 22 is that a lot of those structures were done with optimistic assumptions and maybe debt structures that didn't necessarily align the business with the business plan. And unfortunately, a lot of those events are now coming to fruition. So they're learning from these experiences. So definitely deeper questions and going in 2-3 layers beyond the surface information on the offering memos.
Yeah, I think that's well spoken, but I would ask too, do you think that that they're being over cautious, too cautious? Because I think there's a fine line around that also.
I mean, I can't really speak, right, for them. Are they being overly cautious? I mean, if they've gone through a loss, right, or I mean, I've had even cases where LPs would connect with the sponsor, they got into the deal, never heard a word from them until the email came, hey, we're foreclosing on your property. So in that case, are they being overly cautious? Probably, I would say probably not, if that's the pain that they're dealing with. And for a lot of them, that's keeping them on the sidelines until I guess the wounds have maybe a little bit crusted. So I guess the answer really depends on what their investment thesis is, what their risk tolerance is, and some may be a little bit more bullish than others. So hard for me to say they're overly cautious, but I think they're appropriately cautious.
Yeah. Okay. Matt, how about you?
Yeah, great answers. I'm the risk taker, but I'm doing it like I wasn't doing it 4 years ago, right? And so I think it's very interesting. I believe that investors are now taking a lot more of a responsibility, which they should. Like, it's very easy for LP investors that got into a deal that may have lost money to judge or blame the GP. And unless the GP was lying to them about something, they enabled that and they were part of that, right? Like, it was everybody was raising money in like 48 hours. And sometimes it was people that were brand new. They've never even done a deal. I saw it happening, and they're buying like 100-unit deals, 200-unit deals, and they raised all the money. And then the LP investors are now judging them, right? And so I'm just seeing LP investors asking better questions, being willing to go look at the property, like Vesey was saying, like actually asking questions about the underwriting. That wasn't happening as much 4 or 5 years ago. I'm really curious if everyone has a short-term memory and this happens again. I don't know. I've been doing this for 16 years, but this is the first time that I've gone through a market cycle like this. So I'm just fascinated being a student of the game who loves this stuff is like when things get hot again, does everyone continue to operate the way they used to, or do we genuinely learn from it?
Yeah, I think it does, but I think this is one of those cycles that because it's kind of long, this is a long stretch, and I think that I appreciate the fact that investors are asking harder questions today and more thorough questions because they're really doing more due diligence, and I think that that's important, I think as an operator, when you bring a deal to the market, if you have been conservative in your underwriting and you're putting a deal out there and you can factually back up your data and factually back up your assumptions for an investor that asks good questions, that builds a good relationship between you and that investor. Because I think that that's what the investor is looking for today. Matt, you talked about new people in the business doing 100 deals. Where are those people from 2021 and 22 today? They're nowhere around, right? And it was like an overcrowded market. So, it's the same thing in a residential market, right? When the market goes bad, all the agents get out of the business, it thins the business out. And so it's thinned the playing field out a lot more. And I think it's been helpful or will be helpful going forward. And the operators that stuck this cycle out are going to be successful in the next round.
Yeah, I agree. I call them the fly by nights. It's like there's people that come in and they go, and you see it all the time. And you got to notice like like you, Mike, you've been around and you've been through it. And there's so much value to that. And like that's what people should look to, because the experience is like what I know now after buying 800 doors is tremendously different. But there was a level of like I had to just get in there to figure it out. But then it's like, is this person the type that will quit, or are they going to go all the way through?
Yeah. Hey, I got to tell a quick story because I wrote it down and it's kind of, you had mentioned something earlier, Matt, that made me think about it. But, you know, real estate goes up in value. I don't care where you buy it. If you buy it high and it goes down, if you buy it low and it goes up, it always appreciates in value. So I write about this property in my book that I bought in Dallas, a decade ago. And we bought it at like a 13 cap. So we bought 450 units for $16 million. About 2 years ago, maybe it's a little longer, about 3 years ago, a guy I know that's in the space who's no longer anywhere to be found, bought the same deal at a 4 cap. He paid about 60 million for those 450 units. Real estate goes up in value. I can only wonder today what my life would have been like if I would have just held that deal, because at that time it cash flowed really well. And even going through the market cycle, it continued to cash flow. So, real estate goes up in value, and, there's a lot of mythology behind, buy and hold for long term. And, I think, this goes back to the short term conversation that some investors just want to be in a deal for 3 or 5 years when really you should ride a deal through the cycles and refinance and do cash outs. And there's a lot of strategy behind that. Kind of sticking on the market cycle conversation though, where do you think we are in the cycle? So Michelle, what are you seeing as far as the market cycle? Where are we at? Are we coming down at the bottom, coming out?
That's a good question. And I'm not in the thick of it like Matt and Bessie are, just because I'm not, I'm working with the investors that are selling a little bit on a smaller scale. I mean, we have people that are selling 30, 40, 100 units, things like that, but nothing to the extent that I think Matt and Bessie see it. So maybe I'll kick the can to you guys.
My prediction, Mike, I think we're at the bottom end or very close. And once again, I'm talking about my market, right? I've been coming out with this little funny prediction, but I'm saying 27, Austin, Texas real estate's back and the Longhorns win the national championship. And that's my mindset. I think
You
we're
are
like,
dreaming.
hey, if anyone, hey, well, and I went to A&M, man, so I'm an odd guy, but that's what we'll have to look back. But I think there's like a few sellers that haven't fully tapped out that are, and I'm talking specifically multi, that they're tapping out in the next like 3 to 8 months, and then it's totally done. That's my prediction. Uh, and it's partially based on a feel, but a feel's real in this business. And I'm like Michelle said, like I'm living it, having conversations every single day, talking to everybody, and you get real time data. So I think if the end was the ninth inning, we're in like the seventh and a half or eighth inning.
Time for a
Yeah.
stretch. How about you,
Yeah.
Vessi?
I'll definitely say it varies by market and sub-market, right? Where Austin is probably different from where Atlanta is, different from where Savannah is. So it's definitely important to study the specific market dynamics. Um, uh, Again, I'm not here to say that I'm Nostradamus or anything like that, so nobody really knows where the bottom is, but I'm not sure if we've actually seen the worst of it yet. So probably the next 12 to 24 months is where I see the window of opportunity. And why do I bring that up? Because there's still a pretty sizable wall of maturities that needs to get resolved depending on the source. You're looking at 900 billion to a trillion, again, depending on which source you go after. But until those deals trade and when they're trading today or when they're getting refinanced today, they're trading in a very different environment, environment with 6% interest rates versus 3% interest rates. And so to the extent you have sponsors, right, with deep pockets who can properly recapitalize the deal and weather the storm and hold longer, which is why I think the long-term mindset, at least with me, resonates very deeply. I think those are the people that probably won't have to to take a discount, but others, unfortunately, and I know a lot of sponsors, right, are fighting, doing everything they can to save the deal, but at some point you run out of money, you run out of sweat equity, and the deal has to trade. And in a lot of cases, lenders are now running out of patience, and a lot of them have gone publicly and stated, okay, this year we're gonna not be extending and pretending, we're gonna start taking some keys, and that's where a lot of those opportunities will be. So will we see another extend and pretend for another year? Maybe, maybe not. I think a lot of it will vary by lender, but until that wave, I think, gets resolved, I'm not sure if we've actually seen the worst of it yet.
No, Vessi, and I know you work with both family offices, a little bit more towards the institutional side as well as the private investor. Are those two different investor classes looking for something different? And I always call it, what is your capital looking for, right? So, what kind of return? What's the safety factor, safety valve in there? Are those two groups looking for something different, or you think they're aligned?
Well, I do think the time horizon is different, right? In the family office world, it's definitely more of a longer term mindset. They're not opposed to holding longer. They're not chasing for the highest return. A lot of it, of course, depends on what their investment thesis is, right? If they're looking to preserve capital, which for many, that's their primary objective. High single digit rate of return may be acceptable, right? Whereas with the retail investor who's now getting exposed to the private investment and private offering world, for a lot of them, that time horizon is 3, 5, maybe 7 years, which is why a lot of those deals, specifically in the syndication space, are getting structured that way. And so I think that's probably the primary difference. And then in terms of due diligence, I definitely see in the family office world, right, there's another, they go deeper, right, and which is appropriate. Whereas in the retail investor, world, and that's why I'm so passionate about education, right? It's a lot of times I feel, of course, I'm not speaking for everyone. I don't want to make a blanket statement, and there are definitely retail investors digging deeper, but a lot of times I see decisions made based on social media proof or social proof, and just because your friend invested in that deal, that deal may work great for them based on their investment horizon, their investment thesis, their risk tolerance, but it doesn't mean that deal will be the right fit for you. So I still feel like to some extent people are looking for that easy button, but there's no easy button. There's nothing. The tax code qualifies passive investing as passive, so that's fine from a tax code perspective, but it's not truly passive. At least on the front end, you really have to roll up your sleeves, do the work, dig deeper, and there are really no shortcuts to that.
Yeah, I like what you said though about, there's really no passive income out there. And I think a lot of investors get into deals thinking, they're going to just get straight mailbox money. And, I think they get surprised, right?
Mhm.
I think even as a passive investor, you need to stay involved, right? Like I know with our group, our 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 investors have the opportunity to come to our asset management calls. They all get a calendar link. They can sit there as a fly on the wall, and then we can, offline we can answer their questions. But we want to be as transparent as we possibly can with them. And I think transparency is a big thing today, especially if you have a deal that's sideways.
Absolutely. I could not agree more with you, Mike. And I think that's for any sponsor, actually, that's a great differentiator. I
Yeah.
think being transparent and sharing not only the good news, but also the bad news. Unfortunately, from my experience, a lot of the communication I see or receive, they always focus on the positive. And I'm not suggesting don't keep a positive mindset or solution-oriented mindset, but if there is a problem, share that up front. And if you are able to avoid the problem through a solution you've been working on, that's great. But if you're not, then you're not shocking investors, right? At the 11th hour where they may be getting an email, hey, we're doing a capital call and you have to respond in 2 weeks. It's like, well, this didn't just happen 2 weeks ago. That was probably brewing for at least 6 months. So in that particular example, communication should be starting 6 months to a year out. But I'm not sure if it's fear, right? Fear of delivering bad news. But I can tell you, like from my perspective and an LP perspective, I mean, even as a former lender, right? We didn't like surprises. When you're proactive
Yeah.
and sharing even the difficult news, then at least you can work together through a solution, right? Versus slamming on the brakes, and maybe you avoid the crash, maybe you don't.
Yeah. Well, we're getting to a couple of questions, and a couple of them look good. So I'm kind of going to roll this out. But Ronald is asking, will the multi-use asset, so I guess he's referring to the class, multi-use asset class, which could be retail and residential, right? Mixed use, see the same issues as multifamily. I have no interest in senior facilities, but I see purchases. Texas deal with, we must be saying, because Rod Cleef has gotten really big in senior housing, so he's kind of making a comparison there. I think if I can dig in here, the question really is around is multi-use or mixed use properties going to see the same challenges as multifamily? Um, Matt, you want to tap onto that at all?
Yeah. Well, the way I kind of think about a lot of this is like every deal is its own deal.
Mm.
Like I'm just always looking for the opportunity and the motivation. The cycles come into play, absolutely. But when you're like really dialed in, you're looking for like the right opportunity. And whether that be retail or RV park or multifamily, like if the motivation is there and it's a good location and the fundamentals are good, then it's a good deal, regardless of where we're at in the cycle, is how I think about it. I own one retail building in Pace, Florida, and I really like retail properties. But the key for me is I have a partner that deeply understands rental rates and who can go where and who can pay what price. I'll give you an example, and this is kind of back to the dumb money kind of concept. I worked at a retail brokerage when I was out of college for 3 years. And like I was just learning the game from the guys that were at my company, right? If we had a retail building that we were leasing, like we wouldn't even necessarily have a price. The price depends on who the tenant is.
Yeah.
Crazy, but it's how it is. It's like, oh, your client's Chipotle, okay, the rent's this. Your client's a nail salon, okay, the rent's this. And so, more than any space, in my opinion, in real estate, is like insider trading and knowledge valuable in retail than any other sector. And so, like knowing the brokers and knowing who can, like, we'll go look at these retail buildings and we'll be like, hey, these tenants could be paying double the rent, and here's the tenants that want to go there, and here's what their sales would be. So like that's how I think about real estate in general. I don't think the motivation is there in retail as the way that it is in multifamily, and so that's why there's more of an opportunity in multifamily specifically. But these retail deals are great where they're paying 5-10 year leases. They're paying all the they're paying the triple nets, and you can go and get really good financing because you got tenants with locked in leases.
Yeah. So one of my coaching clients and I, we just underwrote a deal in Charlotte that is 90 multifamily units, and it's a core asset. It's 2 years old. 90 multifamily units and like 7 or 8 retail stores. But when you look at the retail rent in comparison to the apartment rent, it's much stronger. And I think that a mixed use asset is going to carry the load a little bit more than just a multifamily, especially in a down cycle. Because when I look at the income numbers on that particular asset, the just the multifamily alone, the thing was dragging. But as soon as I added the retail to it, it made all the difference in the world. So, I think that there's some merit behind that. Hey, Vessi, here's another question. That let's see. Somebody's asking, what does concern me is the occupancy rate in some markets could be as low as 70%. Could it be a management problem? Maybe. Could be, or could this just be pockets? Are there better pockets than others?
Oh, I love this question because I actually did a live event recently on the topic. Because could it be? It depends. I'll give you the answer you probably don't want to hear, but it really depends. Could it be a management problem? Absolutely. But as always, my favorite saying is you have to peel the onion even if it makes you cry. And I'll give you an example, right, of a deal where I'm not going to mention the market names or anything just for confidentiality purposes, but where the sponsor bought a quote unquote distressed deal. And yes, it was distressed. It was sub 90% occupied. Presumably they got it at a discount, closed on the deal. But what they didn't factor in is that one of the main reasons the property was under 90% occupied was really a function of the local market and something that was completely out of their control due to eviction restrictions, slower processing of evictions. So even after they took over the property, despite best efforts to lease it up, they were operating with their hands tied effectively. And unfortunately, they hadn't raised sufficient reserves to carry that load. They ended up doing a capital call that wasn't enough, and eventually the deal got foreclosed on. So could there be an opportunity? Absolutely, but you absolutely also have to understand the local market and sub-market dynamics and really determine, am I inheriting someone else's problem that's outside of my control? And really understand that, right? So in that situation, it would have been important to do that deeper level of analysis. And if you still decide to proceed with the deal, then one, capitalize it accordingly, because maybe the storm will last longer than you projected will. And two, maybe negotiate a deeper discount to reflect the true state of the property and not just, hey, it's a discount from the peak, which doesn't really reflect the current market dynamics.
So true. And I want to start to cycle out and land the plane here this afternoon, but one comment I have to make, I think it's very spot on. You can look at a market, but you really got to look at the submarket, because that submarket in that market may be totally different. Like we own a couple of assets in Tampa, Florida. And Tampa as a whole is a pretty good market. But when you dig in, there's a few submarkets, and there's 15 submarkets in the Tampa market. But some of those submarkets aren't even worth walking through, right?
Yeah.
And we own some assets. And if you look at Florida right now as a whole, rents in Florida, or occupancy in Florida, has been about 85 to 87% for the last 2 years across the board. I have an asset that is, we're 87% occupied, and we've struggled to get above there for 2 years. And, we're right where the market is. Now, I like Antonio's question, because he says, is it a management problem? I don't know in Florida. In Tulsa, I can tell you we have a management problem. But in Florida, I don't know that it's a management problem, because the whole market is that way, right? Yeah. So, Matt said earlier, it's local. Real estate's a local business. It's local to that market. So you really have to look at the market, look at the submarket, and kind of evaluate it. I want to kind of ask one more question here. What questions, and boy, I can think of 3 or 4 just from the conversation that we've had this afternoon, but what questions should investors be asking before deploying capital into a syndication today? So Michelle, I want to start with you. What do you think investors miss or don't ask that they should be asking?
Yeah, I think, as you're talking about the markets, I was going to actually ask you, do you typically, sorry, not to kind of get off topic, but I was thinking about this from my investor standpoint, because in Massachusetts, there's a lot of regulations and restrictions going around with what landlords can do and rent controls. And there's a lot of conversations going around on that. In Massachusetts tends to be a very tenant-friendly state. So it makes it difficult for the landlords. We have all sorts of programs where people can, squat and it'd be okay. So, what should they be looking at? Should they be looking at the sponsors in the markets that they're in the regulations surrounding the landlord and tenants rights? So, is that what you guys are looking at primarily as you're looking in markets too? How you can be, continue to grow your rents without being restricted by local governments?
So I knew somebody'd get political, but
I didn't want to make it political, but I was hoping to kind of get that idea, because we have a lot of people that are moving out of markets because of rent control and because of the restrictions that they're putting on in, the allowance to having tenants squatting in their properties. And, we see that a lot. We have people that their exchanges get pushed off because they can't get a tenant out. And now so what do you guys, how do you go about that? I think that's one of the big things that our clients see and have experienced and don't want to have that same experience as they're going into their next investment.
So I'm really a market-driven investor, and I want to be in a market that's tenant or landlord friendly, not tenant friendly, because I don't want to wait 90 days, 180 days to have to get somebody out of one of my apartments, because that doesn't do any of us any good. So
right.
We monitor right now. We monitor about 25 submarkets around the country, and they are all in red states, and they're all landlord friendly markets. So
stay clear of Boston.
Yeah, for sure. So did you have a question though that investors should be asking? Is that
I mean, that was kind of my question. You know, what kind of in properties and markets that they should be in. I think that that's what they're looking at
yep.
in those occupancy rates for those properties.
Yep. Great. How about you, Vesey?
I would say if there is one question you ask how do I lose money on this deal? And have the sponsor walk you through that. And that really brings a discussion around key risks, not the 20 pages that are in the PPM and the legalese that comes with all deals, but really take a step back and walk me through what are the 3 to 5 key risks that you see with this deal and how or why do you think these are mitigated?
Yeah, interesting. And there probably are good 5 points in that question that you could talk about as a sponsor, right?
Absolutely.
Rent growth, occupancy, cap rate, you know.
A lot, yeah.
Yeah.
Capitalization of the deal, sponsor know-how, track record. I mean, a lot of it brings up a very rich discussion. So one simple question, but unlocks a deeper conversation.
Right, right. How about you, Matt?
Yeah, good ones. This is I guess a broker question. I always ask the brokers, what do you not like about the deal? But I think it's important to really deeply understand that as much as this business looks fun and, you know, we're networking and having drinks and dinner and this and that, like this is a very competitive business and you just might not see it. And so what I would do is if I was going to invest with someone, I would put them on the spot in a sense and say, like, who are the top brokers in the market? Who are the top property managers? Who is your competition? And if they don't know these answers, then they're not extremely locked in. And so you've got to understand, are your operators locked in? Do they know everything? Like, we know if someone puts a deal under contract in Austin or San Antonio, I'm on that. I have to know who that person is that's buying it. And it's not always easy to find out. Sometimes you got to find out after they close. But I want to be on their webinar. I want to see how they pitch. I want to see how they're getting investors. Like that's a side note, but that's the mindset. And so you've got to find people that are really locked in as operators. You want to know, like, is this their full-time job? Are all the roles that are required being covered, right? Asset management, investor relationship, all that kind of stuff. Do they fully understand everything? And if they don't, then there's a good chance that something's always going to go wrong, right? But like, are you operating with people that are going to figure this out because they're asking the right questions and locked in and thinking of the things that you don't have to tell me to do it because I just care enough that I want to do it. So the questions are really based around understanding how locked in an operator is, and you can find it simply. Who's the top brokers? Who's the top managers? Who are the top owners? Who's your competition? And if they can't answer those questions, to me, that's a really big problem.
Yeah, 100%. Well, I appreciate you guys. I appreciate you taking time out of your day and evening and being here and, giving some value. I always say that when we do this, we're giving the people who come and show up a gift, right? The gift of our knowledge, the gift of our expertise, the gift of information. And, I want to thank everybody who was listening in tonight. Why don't you guys tell everybody how they can get a hold of you and the best place to find you. Michelle, why don't we start with you?
Sure. So I'm with Northern Bank. We are a wholly owned subsidiary, Northern 1031 Exchange, and you can find us very easily at nbtc.com.
Nice. Vesey?
I'm very active on LinkedIn, so I just posted my profile link there. And then for underwriting, deal analysis, mastering multifamily underwriting.com. I also wrote a best-selling book on the subject, which you can find on Amazon. And for passive investing insights, it's dbacapitalgroup.com. D as in dream, B as in believe, A as in achieve.
Nice. Matt?
Love it. Same LinkedIn, Vesey. I'm just adding you now, and it's a gift to me too. I mean, this is all about people, and Mike, I appreciate you putting this on, and Vesey and Michelle and everyone listening. And I keep coming back to just reckless value add for everyone you come across, and that's how things work out in this business. Mike, you're doing it. I want to show up and not be a speaker and be a listener. Like there's just everyone here who's here. Congratulations, you're learning, you're taking real things, and hopefully you just put it to use. So
Yeah.
I put my LinkedIn chat there, and I'm honored that you make the space, Mike.
Yeah, absolutely, Matt, and I appreciate you. And Matt and Vessi, you both should connect with Michelle on the 1031 side, because she's awesome at what she does. So, get that connection. And as follow, for connecting with me, anywhere you hang out on social media, I'm there. Follow me on LinkedIn. I'm really active on LinkedIn and Instagram. So reach out to me, and if I was talking publicly on a stage right now, I'd have everybody pull their phone out and connect with me on LinkedIn or on Instagram right now. So, but that's the best way to reach out to me and connect with me. You'll get the quickest response there. Hey, everybody, thanks for being here. I appreciate you guys. I appreciate all the people who are listening in, and we will all connect soon, I'm sure.
Thanks,
Thank
everybody.
you. Thanks.
Thank you.
Everybody, bye.
Bye.